past and than we do in the present. And this financialization in turn is going to make consumption sustainable for a very, very long time to come. And we are also going to see the government's finances improve. And they have been progressively improving from the bottoms of the COVID. And you're seeing a very, very stable, manageable current account deficit. The fiscal deficit has been almost to the trajectory which we wanted it to be. And the government has also invested and given a boost. Government has spent a lot of money in the last few years. Now it's the turn of the private sector to spend a lot of money, and people have to spend a lot of money. They continue to spend a lot of money. And lastly, there's one thing that has to happen for us, which is still open-ended. That is, exports should grow faster in the future than they have in the past. I know this is not the best time to, say that, because the environment still looks hazy until we make the tariff deal with the United States, I think, and the FTAs with several other countries which are in progress. I think that there'll be a lot of uncertainty, but I expect that the exports are going to also, take off, and we are going to see a different trajectory in the coming years than we have in the past. And if all this happens, I think the Indian economy will come into a lot more money in the future than we have in the past. The last 5 years have been quite adventurous, if you look at it from the point of view of the stock market, where people have shown exuberance and unusual and irrational exuberance at times. If you look at all that, you may feel a little uncomfortable, but I believe that everything will normalize over a period of time, and I think that our economy will become more mature going forward, and the government has all the levers to address issues as and when they arise, and that's a recent experience, and there is no reason to believe that we would not be able to continue to do that. I think we will be able to manage that quite well. I think the money is there. It's quite evident that the money is there, because otherwise we would be in the place that we are in as an economy. And people have the confidence to borrow from the future and spend in the present, which means that they are committing to that productivity in the future. It's not just, it's not like America. Indian borrower has to, be far more responsible than America. It's not possible to be like in the US. It's difficult for them to get the credit, and they know the value of the money they're getting. And they are also spending that money judiciously. That's my sense of how people are, acting. But the huge entry of people into the capital market, into formalized financialization, is something that we have not seen ever before in our future. And I think that that's going to be the place where we are going to see a lot more action. And I expect a lot of new entrants into the world of investing, into the world of finance, into formal economy, who are all going to contribute and who are going to be very productive in the future. And things will get better from here. So I think the money is there, and there's more money coming. Thank you, Captain.
Thank you, Shyam. It's a great insight, and 3 different insights, and over 620 viewers are watching. I got lots of questions addressed to each one of you. And what I'm going to do, Dr. Narayanan, you're there, and Arun is also there. I'm going to address the question what is collected from the various people. I'm going to pass it on to them. I'll now pick up the question which has been addressed to Dr. Narayanan first, and it's from Mr. Ram, again from to Ram. He says, sir, given your experience shaping India's macroeconomic policies, how do you interpret the current paradox, high GDP growth alongside stressed household budgets and widening inequality?
Sorry. Yeah, that's how do you go ahead?
How do you interpret the current paradox, high GDP growth alongside stressed household budgets and widening inequality? That's what he's highlighting.
Okay. I think this is a very, very, very important question. Inequality is huge. Inequality is huge because if you really take 140 crore people, I would say if you look at all figures, that the top 1% owns 10% of the wealth in the country. And if you take the top 10%, they own more than 50% of all the wealth in the country. That means hugely it's a skewed growth. And the main reason, if you really look at the reason is that a lack of earning productive skills in several states. I think the good example would be to compare Tamil Nadu and Bihar. where Tamil Nadu high level of education, high level of skill formation is leading to much better outcomes in terms of employment, where in Bihar, low levels of education and low levels of skill formation is making them depend entirely on manual labor. So here, I don't know whether you call it policy, you call it political ideology, or you call it different DNA of the different states. But definitely, this kind of difference if you see Tamil Nadu, if you see Kerala, if you see Telangana and Andhra Pradesh, it is correctable. It is correctable over a period of fairly short in the history of 15 or 20 years. It is correctable. So it is not that this differential need not grow away, but it's very much in the hands of the local governments and the local people to make this happen. So yes, high inequality exists. High inequality is leading to skewed expenditure levels, definitely, to overvalued real estate levels, etc. Absolutely, conspicuous consumption, certainly. But it is also, I would say, on the positive side, that if I see the development of a state like Tamil Nadu, Maharashtra, Gujarat, etc., I see that this is correctable over a period of time.
Thank you, Dr. Noyan. In a question which is in sync with the similar one is Mr. Raghuveer is addressed to Mr. Dr. Arun Kumar. His question to you, sir: the rich and poor gap is widening very sharply. How much the current economic growth is actually accruing to the top 1 to 5%, and how does this distort the overall economic indicators? This is addressed to Dr. Arun Kumar.
Thank you very much for this question. As I was saying, we cannot talk about Indians and people. Indians are very disaggregated. That's what I was trying to show, that the organized and the unorganized sector are very different. The incomes of the organized sector have been growing, but the incomes of the unorganized sector have been declining. So that's why the inequality is rising. It's not just interstate, but within each state also, within Tamil Nadu also, within Maharashtra also. And you can see in Maharashtra, for instance, the Vidarbha belt has a lot of suicides because the farmers are committing suicides because their incomes are very low. So this inequality is across states, it is within states, and it is basically because of the split between the organized and the unorganized sector. And rural demand is actually very small in India, because you see, rural demand depends largely on agriculture, and agriculture is only 14% of the GDP. Now you can add a little bit of services. Maybe 20% of the demand comes from rural areas, 80% comes from the urban areas. So therefore, even if rural demand rises by 10%, is very small compared to if the urban areas or the services sector now 55% plus. So if the services sector growth takes place, that will lead to far more demand, right? What will happen in agriculture, because it's become a minor sector, there, even if you have a 4 to 5% rate of growth, the demand will not rise that much. So I think what we need to do is we need to equalize all this. So if we are to do something like this, then we have to boost agriculture incomes. Agriculture incomes are very low in India. The last survey was 2017-18, which showed that an average agriculturist earns, 27 rupees per person per day from agriculture. So they have to do other things. They cannot depend on agriculture alone. So at 27 rupees per person per day, you can see the annual income is only 60,000-70,000 rupees in 2018. That would have gone up to maybe 1 lakh of rupees. But 1 lakh of rupees of income from agriculture for a family is very small. So they are close to the poverty line. So how to boost agricultural income, that's one. Second is the micro sector is very large. The micro sector has 7 crore units, and average employment is 1.7% per micro unit. Now you cannot make them organized. Just like agriculture cannot be turned organized, the micro sector cannot be turned organized. And of the MSME employment, micro sector has 97.5% of the employment. So unless you boost the micro sector, demand in the economy will not rise and inequality will not become less. Unfortunately, what the government is doing is it is killing those areas where employment generation is buoyant. So the government increases their capital expenditure on highways and on railway freight corridor, on power sector, on IT sector, but these are very capital intensive. They don't employ many. Say, for instance, earlier on a road project, hundreds of people were seen to be working. Now 10 people are working with bulldozers and with tractors and so on. So even these sectors don't generate employment. Where is the employment generated? In the Rural Employment Guarantee Scheme, in education, in health, in rural development and agriculture development. But these are the areas which are lagging behind. And that's why employment generation is not very buoyant. And if the unorganized sector was buoyant, you'd get a lot of employment. But because the unorganized sector is declining, you don't get that employment. Therefore, the inequality rises. So therefore, what the government has to do is boost agriculture, boost the small and micro sector. Then purchasing power will come in the hands of the presently poor, and they will spend a lot. If you boost the income of upper middle class and the rich, they are not going to consume. Out of every 100 rupees you give them, they may consume 5 rupees. But if you give the 100 rupees to a poor person, a farmer, or to a micro sector worker, he spends the entire 100 rupees. He'll buy a chappal for himself, he'll buy a sari for his wife, he'll buy some school bags, some katori. So to boost demand, you have to shift income. So if the inequality keeps rising like this, demand will be slow, and then the corporate sector's growth will be slower. It will slow down. That's why I said it will be unstable. So therefore, you have to have policies which are focused on trying to boost the income of the lower 94% in the economy.
Perfect, sir. I think, Shyam, there's a question. I think people are listening to the raising question. Now the question is addressed to you on similar lines. The two questions I'm combining, Aravind and Pushpa. And the first question is this phase of high growth and rising asset value reflective of a strong fundamentals, or are we experiencing another liquidity bubble? In continuum, is also want to know how worried should India be about the growing inequality between the top earners and the rest of the population? What are the long-term consequences of the same? Because seeing the stock market is only a few very negligible percent we are there, and as the speaker said, quite a number of them earn, some lose heavily. What do you think in the present scenario to address the concern of Pushpa and Aravind?
I think definitely the market is under the influence of excess liquidity. There's no doubt about it. And that reflects in the valuations of businesses. The stock market valuation that you currently see is definitely a bit overdone. And it is primarily because of lack of opportunities in other asset classes. And the excess valuation real estate is pushing a lot of people to take money out of real estate and come to stock market. Today, with gold also hitting highs, I think a lot of people who want to invest in gold are thinking, let me invest in stocks right now, because relatively stock market seems to be a better place. Having said that, I think that the larger Indian companies are in better financial health today than ever before in the last 10 years or even 20 years. So the larger financial companies, larger Indian companies, not just financial companies, the larger Indian companies are in much better financial health, and that in turn provides a lot of stability to the stock market. So even though there will be a little bit of froth in the stock market, let's say markets are overvalued slightly, any change in valuation will again make more people show their conviction in Indian assets, in equity. That's my sense. And we will see corrections, for sure you will see corrections, and that is very healthy also in the long run. And these corrections will see more people coming in and participating. It will be a very dynamic market. It will not be one way, as we have seen from the lows of the COVID to the present. But it will be a market which is constantly adjusting to the economic realities. And the economic realities will also see a lot of ups and downs, because that's the nature of the times that we live in. So overall, an investor in equity market should be prepared for all this. I think that is the most important thing. You must be ready for these ups and downs, and you must be able to capitalize on these opportunities. Talking about inequality, I think that today we are seeing the highest tax rates in our post-liberalization history in personal finance. So you are seeing highest taxation in the hands of individuals who are rich. Okay. On the other hand, you are seeing the lowest tax rates in post-liberalization history. Post-1991, I'm saying. You are seeing the lowest corporate tax rates. So what the government is telling is, if you keep the money in the company and invest in the business and, create assets, then, you're free to enjoy a lower tax rate. But if you pay the money to your owners, business owners, who are essentially rich, then they have to pay out 40 rupees out of 100 rupees that they get. Now, the government has done almost everything it can do to, address inequality from the angle of taxation. If there is still this phenomenon of the rich becoming very rich, it's a function of stock market valuation, which is dynamic. I think that if you have a correction in the stock market, then will you say that the inequality has come down? Right? If you see a stock market which is 25-30% cheaper than where it is today, will you say that the top Indian corporates are the business owners, the big names, have all now come to a more realistic level and you'll find it acceptable? I think that this whole debate is based on notional wealth, and they are not going to sell their wealth tomorrow and do anything. Okay, so I think that statistically it looks very, very alarming, but in reality, I think that the more important thing is how many people are coming into the middle class, how many people are able to add different things to their consumption pot or basket. How many people are able to enjoy a better quality of life? How many people are able to buy a two-wheeler? How many people are able to build a house? How many people are able to buy a car? How many people are able to educate their children in universities? How many people are able to get the best medical facilities? So I think that you have to look at that and not look at whether how rich you are relative to the richest guy. I think it doesn't really matter. If I am coming into the middle class and I'm getting everything that I aspire for, it doesn't matter how rich the richest guy in the country is. I think it's more academic to me, and I would think that's how an ordinary Indian would view it.
Great, Shyam. I think it's a good point. And now I have a question for Dr. Narayan. Sir, you're there, Dr. Narayanan. Can I address the question to you, sir?
I am here.
Yes, sir. The question to you is from Mr. Mittal from Nagpur. He says, what reforms or the rails should India consider to ensure that growth is inclusive, inflation is contained, and asset price inflation does not result in future correction of crisis? So, based on your experience as advisor at the highest level of Prime Minister, what should be your view as of today?
That's a big one. That's a big one. So certainly start at one end, certainly agriculture, modernizing agriculture, making it more income earning for the agriculturist, taking it down the value chain, right up to marketing, adding value to the product in terms of what shall I say, in terms of conversion from raw material into something which is good to the table. It's happening, but it's happening. You can see when you go to the store, you can see all this is happening, but it's happening so very slowly because there's not enough push being given by government to this particular aspect of it. So that is one big area. The second area, which is already pointed out, is certainly micro and small industry. They need technology, they need R&D, they need marketing, they need they need access, they need logistics. These are the kind of support that the government should give, because they can't do it by themselves. I mean, if you take a district like Nilgiris, a large number of self-help groups doing wonderful things, but they are not able to expand. They are not able to expand because they don't have access to the market, they don't have access to technology, they don't know how to brand their goods, etc. So I think this is one area that government should certainly do. So if I were to look at inclusive growth, certainly I would look at the small scale sector and the agriculture sector as the origin of inclusivity.
Thank you, sir. I think great insight. And here's the question addressed to Dr. Arun Kumar. So many of them coming and trying to put what is relevant to the talk discussed. Only we are putting it. I know a lot of communication happening in the chat box, and I'm not really looking at it, sir, because we are not here to really address the personalized questions. So bear with me. You can just see them, and if something you think is relevant, we'll try and address them. We got another 10 minutes to go. There are some lovely questions that come from all over India. The next one is come from Mr. Butt. It's addressed to Dr. Arun Kumar. He says, to what extent do you believe the parallel black economy contributes to the sudden surge in asset prices? Are we missing a hidden flow of money unaccounted for in the official data? Because you're an expert in the black economy. You written a book post 1991 war. I think somebody has really researched and picked up this question for you, sir. Over to you, Dr. Arun.
Yeah. So, the black economy generates a lot of income. According to my estimate for 2012-13, it was 60% of GDP. So on a 350 lakh crore GDP, 200 lakh crore would be the black income generation. Now, the problem with the black economy is that investment productivity declines. So therefore, it leads to a lower rate of growth than the potential of the economy. So while the black economy leads to a higher GDP, but the point is that it could be much higher. So I've shown in an article in 2005 in South Asia Journal that because of this black economy being more than 10% of GDP from mid-70s, India is losing on an average 5% rate of growth. Now, if this 5% rate of growth could be added from mid-70s onward, today Indian economy would be $30 trillion rather than $3.8 trillion. So we are missing out something like $26 trillion of GDP because of the existence of black economy. Now, what does the black economy do? A large amount of investment goes into unproductive assets. And for instance, buying gold or, taking the money out through hawala, through a layering process and, bringing it back. So round tripping is taking place because of the use of black economy, and that goes into the stock market and various other things. And that leads to a boom in the stock market as a result. So, what is happening is that because income from white assets is not comparable to those from the black assets. Therefore, the shift is towards the black economy. And that black economy leads to, loss of productivity in the economy. To give an example, suppose you make a road. You don't put enough tar in it. The rain comes, the road gets washed away. So the investment is not giving you the productivity you should have given in terms of better traffic. There'll be potholes, people will die, there'll be axle broken, etc. So I call this digging holes and filling holes. So large part of the black economy like digging holes and filling holes, which leads to loss of investment, loss of productivity, etc. So black economy leads to several negative aspects of the economy. So while the economy is larger than what the white economy data suggests, but it also has negative effect because it slows down the growth of the economy. And the slower growth means less of employment. It means other, inequality, because this black economy is concentrated in the hands of 3% of the population. So 3%, I showed that in 1996-97, if you take the white economy, then the ratio of income between the rich and the poor is 1:12. But if you include the black economy, then it becomes 1:57. So the real inequality comes from the black economy. And that then suppresses your productivity, suppresses your demand in the economy, and therefore leads to slowing down. So it makes the economy very unstable. And also it has political effect, it has social effect. Your politics gets affected, so your political class is unaccountable, and therefore it doesn't deliver. And social effects are also there. For instance, education is not properly done because the teacher is more interested in doing a tuition rather than teaching in the class. The doctor doesn't cure you in time so that he can make more money, can give you more tests, and things that are not needed are done. So it has social effects, political effects, and economic effects. So black economy is, in my mind, the single biggest problem of the Indian economy. So while it means additional purchasing power, no doubt, in the hands of the top 3%, but it has deleterious effects on the entire economy and creates much more inequality than the white economy alone would have done.
Thank you, Doctor. As usual, in your own style, I think it's been put forth so beautifully. Now, I think there's an interesting question has come to Shyam. Maybe another 5 minutes more. I'll try and accommodate as many questions as possible. Shyam, this question is from Mr. Satish and Jindal. I combined two questions. He says, given your portfolio management perspective, what hidden risk do you see beneath Indian seemingly unstoppable market rally? And he also wants to know, in an environment of such high prices, volatile signals, and aspirational spending, what should middle-class investors prioritize to avoid long-term financial vulnerability? Because I know quite a bit of middle-class guys that lost huge money. And what would be a single word of advice under the present circumstances?
Yeah, I think the middle class would reorient their investment focus in the capital market right now to invest more in larger companies. I think that the middle class is now almost obsessed with buying smaller companies. There, I think the risks are much higher. So I think that the middle class should definitely orient towards buying larger businesses, because the larger Indian businesses are in much better financial health and capable of weathering any adverse economic circumstances, and they are much better placed than the smaller and the mid-sized companies. So I think that the middle class should definitely focus on investing in larger companies right now. If you ask me what is the risk to the investment market or the future of the market in the near term, I think that the liquidity that the market is receiving right now may be inadequate to the kind of capital raising that issuers of equity want. Like, I think that the amount of money which corporates and investors in various companies want to raise through IPOs, FPOs, through placements, all these things is of a much higher order than the kind of liquidity that the market can provide. When the market runs out of liquidity and the issuers are still very hungry for liquidity, I would think that a correction is likely to happen. And that correction is something which the stock market seems very, very underprepared for. So I think that the market has to prepare for that, because corrections are a part and parcel of the equity market. And you will see corrections in every market cycle. Sometimes the corrections could be very deep and long running. Sometimes the corrections could be not so deep and short lived. I think we have had an era of the second category so far. Last 2-3 years, we've seen short-lived corrections. And I won't be surprised if we have a long-running correction for a few years also, because it's entirely a function of a global equity sentiment. And it's quite likely to happen. When it happens, the investor must be prepared, both in his portfolio, by positioning it towards more safety. And he must also prepare himself to invest when it happens, because that is what will give him future wealth. Because such an opportunity should never be missed. As a portfolio manager, I would like an investor to do all of these things.
Excellent. Keep adequate safety net around you, and many times we stay invested, you can do. But anyways, next question. I think one last question to each of the speakers. I got a lot of questions. We picked up one each, with your permission, sir. The first question I'll have to Dr. Narayanan. The question is, sir, historically, the bullion and the real estate acted as a buffer against the stock market volatility. Today, all the three are rising simultaneously. What structural or policy shift could explain this unusual correct correlations?
No, it's not a policy shift that can explain this correlation. It's a market. It's really the market. The market is valuing, and the price. Okay, there are two separate boxes. The bullion increase is related to international market, international geopolitics, things which are happening around the world, and particularly the prices of oil, prices of alternate commodities of metals, etc. Silver is also rising extremely fast. So this is a feature of the market. There is not a single country's policy which can adjust the price of gold internationally. So I don't think that that is possible. If you look at real estate prices, certainly real estate prices are rising as a consequence of all that we have been discussing this evening. There is more money, there is more liquidity, there is more investable capacity, there is more debt that is available, and certainly the returns out of the piece of land in agriculture are very, very much lower than converting it into real estate. And if there is a market for a growing real estate market, and therefore if there are buyers, and where do the buyers come from? The buyers come from the aspirational middle class, from the youngsters. So if there are buyers, definitely the seller will find it much more capable of making more money out of selling his piece of land rather than to grow potatoes or tomatoes there. So, I mean, this is, I would call it a virtuous cycle. We only have to make sure that our breadbasket does not get disturbed because of this urban explosion.
Thank you, sir. Thank you so much. Now, the one last question to Professor Arun Kumari is, sir, these questions come from Ms. Mini. She says that the GDP numbers are being revised upward repeatedly. do these figures reflect real on-ground economic well-being, or are they masking structural weaknesses in employment, wages, and consumption? He also want to know, in your assessment, where is the money coming from? What component of economy is supplying the surplus capital, and which is it sustainable in the long run? A quick answer to this.
Yeah,
I know it's
yeah.
difficult, but
So there are several questions rolled into one. Let me say, what's happening is that the organized sector is having large growth, and that is where the money is, and that is what is circulating in the stock market. That's what is circulating in buying gold and so on. And why the preference for gold? Because globally there is huge uncertainty. Whenever there's uncertainty, people go into gold. The central banks are also going into gold because now the de-dollarization is taking place. So China is shifting to gold, our RBI is shifting towards gold, etc. So there's a lot of gold buying in the international market, which is pushing up the price of gold. So in other words, the whole point is that you see now we are a globalized economy where different parts of the world affect us. So what used to happen before 1991 is different from what is happening now. Before 1991, there was a switch between the stock market and the real estate market. Now there are many more assets. You can hold your money abroad. You can hold it, in different ways. And the gold prices globally used to affect us. But gold is now being affected by the uncertainty that is there. Now, regarding the GDP revision, there are two things. One is that you see the GDP, the method of calculation itself is incorrect. And that's why there is revision going on all the time. And as I said, the unorganized sector is not captured in it, and therefore the unorganized sector not being captured, it is overinflated. That's what I am saying. Third is that the GDP doesn't reflect the well-being of the unorganized sector, because the GDP is reflecting the well-being of the organized sector, which is growing. The unorganized sector which is contracting, but then we are assuming that the GDP of the unorganized sector is also growing at 6.5%. So the well-being of the unorganized sector is not reflected. Secondly, even the organized sector, there's a lot of disparities. You can have workers working at, a small income. You have contract workers working at low incomes. And then you have the managerial class where the incomes are growing. And then in the software industry and the computer industry, the incomes are growing. So there's a dispersion there also. So the average GDP doesn't reflect this thing. And the structural problem is the organized and the unorganized sector, as Mr. Narayanan also said, and I said earlier, agriculture is a problem, the micro and the small sector are a problem. These problems need to be addressed, and those are structural problems.
Thank you, Doctor. And one last question to Shyam, and maybe a quick short answer so that we wrap up in time. The question is from Mr. Sudarshan. Sudarshan is from Dindakal. He says, are retail and high net worth investors responding rationally to the economic signals, or are current investment flows driven by behavioral biases or herd mentality or misinterpretation of macro India? Is it the economy going in the right direction? And what's your advice as high net worth advisor to individuals?
Behavioral biases are part and parcel of the equity market. There will be no equity market without behavioral biases. And people with more money have a higher tendency to show higher behavioral biases. It's very normal. As far as the retail investor is concerned, he cannot afford to show behavioral biases, because if there is a loss, then for him, it can really pinch. So I think that the retail investor has to always keep his behavioral biases in check. As far as the HNI or the ultra HNI is concerned, I think that even if he has behavioral biases and there are some ups and downs, he can weather it. It will not really affect his day-to-day life. And, he can wait for some time before he, makes more money. So the needs of the two are very, very different. But I believe that any investor should keep his behavioral biases constantly in check. And they should be driven less by recency and more by the future. So I think if you're able to do that, then you will be able to participate much better in the equity market, get much more value out of equity as an asset class, and stay the course much longer. Because I think that eventually it's all about staying the course. What behavioral biases are doing to people is it doesn't allow them to stay the course for 5-10 years in anything.
Thank you.
You have 90% of investors don't stay beyond 2 years in anything, in any investment. So if you're able to stay the course, then I think that you are going to overcome behavioral biases and you will be able to do much better in the long run.
Thank you, sir. I think we come, and maybe before we close, one final thought. I want to request each one of the speakers to share your 30 seconds insights on where is the money coming from, and all that discussed. So many insights that come. So start with Dr. Narayan. 30 seconds, your thoughts on the subject, which is very, very relevant, and most people will be really interested to know that. Over to Mr. Narayan. 30 seconds, final thoughts.
I think a lot of government investment, capital investment, money is flowing in. A lot of improved corporate performance, financial market performance, a lot of money is coming in. I said a lot of retail debt and consumer spending, a lot of money is coming in. Agriculture production has increased, a lot of money is coming in. And real estate, finally.
Thank you, Dr. Narayan. Arup, what's your
Yeah.
thought?
So, we have to distinguish, as I said, between money and income. Money is a part of your portfolio of assets. So money doesn't come in unless you make savings. So incomes lead to savings. And savings are very disaggregated because those, like Hindu had a story day before yesterday, 90% don't save. Only 10% are saving in India. So the savings are coming from the top 10%, and that too from the top 3%. And the top 3% also, a lot of savings are escaping the economy through flight of capital. So therefore, the full savings is not coming in. It may be round trip back into the stock market. That's another matter. Agriculture is very small in India. So not much saving is coming in from agriculture because only 14% of GDP and spread over 11 crore farmers. So not much savings are coming from there. They're very small saving. It's the services sector, which is very large, more than 55% of GDP. It is from there that the savings would be coming into the thing. So this is a very disaggregated analysis that is needed. We cannot say that there's people of India. We cannot say Indians, the people of India are very diverse. Indians are very diverse. So we shouldn't lump them together. We should disaggregate them and then find out who's saving and who's investing.
Thank you. I go to Shyam. Before that, I also want to request Mr. Lakshmi Narayan, my president of MMA. He's again a corporate leader. Maybe he want to share a thought, 30 seconds on where the money coming from being business. Over to you, Shyam. In the meanwhile, Mr. Lakshmi Narayan may join. Shyam.
I think money is coming primarily from the government. It's coming from the banking system. It's moving across asset classes, and it's moving from assets to consumption. And I think that all this is basically giving people a wealth effect and a confidence to spend. It's important that these trends are always kept in check and never go so much overboard that we have to have drastic corrections. So I think that it's important that a balance is constantly maintained in keeping money in the right place.
Thank you, Shyam. I'll now go to Lax. You have been pumping money in the hands of people to create wealth. And what's your thoughts, Mr. Lakshmi Narayan? You have to unmute yourself. You have to unmute, Mr. Lakshmi Narayan. One final thought.
He's not able to unmute.
Oh, listen, Shankar. iPhone.
Sir, yes, sir. You can try now, sir.
Yeah, you can unmute now.
Yeah. No, absolutely. It's just been a wonderful session listening to all the speakers. My view of where the money is coming from is, what Mr. Narayanan said and what some of the other speakers also said is a lot of money is coming in from, land monetization. And with a lot of agricultural lands getting converted into commercial and residential real estate parcels. Now, overnight, one of the speakers said like it's gone 2x in 5 years. It's gone 5x in 5 years in some of the markets, and suddenly who were agriculturists holding land over the last few years, few decades, and now sitting on crores of money and land monetization finds its way back into either land or in gold or in similar such activities which are cash economies. So that's where I guess money is coming from.
Thank you, Lex. And Satyamurthy sir, one final thought. You are the creator of this. You would like to say something? And before that,
Not really. Everyone has said the best of things.
Thank you, Shankar.
Carry on.
So, thank you so much, gentlemen. You have joined us and sharing your great insights. You are separated, but you're not there. The MMA would have given a nice memento. Since you are there, we would like to present you a digital memento. What we do is, on behalf of you, we go to the school where the poor children are studying. We present them with the book, textbook, all of them on your before, because people like you come and speak at MMA. That is what adds tremendous value to MMA. And this is what we share with a lot of poor children, so that with your blessing, they all do. We do it with a lot of schools which are really government-aided schools. Thank you so much. Your presence add tremendous value to this evening discussion, and quite insightful. I think over 700 viewers are watching the program from different social media portals. It's indeed a privilege to hear you online, and thank you once again. And it's lovely having you with you. Till we meet again, sir. Bye-bye and good night.
Thank you for
Thank you.
organizing
Thank
Thank
you.
you.
for the gift to
Thank
the
you.
students. Thank you very much.
Thank you very much.
All the best. Bye. Bye.
Thank you,
Mr.
everybody. Good
Narayan.
night.
Thank you, Satyamurthy. Thank you, Dr. Narayan. When you come to
Thank
Chennai,
you.
we'll catch up with you. We'll come and meet you. When Satyamurthy is there, we'll come and talk to you sometime. And the entire talk will be recorded. It's been transcribed and will be published in our digital magazine this month. Thank you. Thank you so much. And thanks to all the viewers who joined us. So many questions have just come in the chat box, but no, there's so many other questions that come. We have to prioritize based on what actually the discussion on the theme. That's why the committee which picked up the question sent to me is not picked up your question. Thanks anyway for joining us online and sharing your question. Thanks so much to everyone.
Thank
Good
you.
night. Till we meet again.
Bye.
Bye-bye and good night. Satyamurthy sir, 7:35 sharp. We closed it so
Yes.
that you can go and have the dinner properly. Thank you,
Good
sir.
night, sir.